live streaming on YouTube. And then once I've done that, I think we can get started with the formal part of this webinar, but keep talking in the chat. And if you have questions, you can already put them in the Q&A tab. Live streaming on YouTube. Okay, that's done. Okay, so we already have 200 people in here, and I'm expecting more. Once we hit 3 o'clock, I think there'll be a lot of people that will join us, and maybe even after as well. Hi, Oliver. Nice to see you in the webinar. Interested in the double tax issues? Yes, well, that is one of the big topics we will talk about today. Okay. So now that there will be more people joining the webinar, I just wanted to repeat this. Use the chat to introduce yourself to each other, to network, to meet fellow like-minded e-residents and business entrepreneurs. Use the Q&A tab for your questions, and we will try and answer as many of them as we can throughout this webinar. I do have a couple of colleagues on the call who are answering questions in writing, so don't be surprised if you get answers in writing rather than us saying them aloud. Because we are expecting so many of you today, we knew that we would need some help with answering those questions. Okay, so now that we have over 200 people in and we're at 3 o'clock, I'm going to start the formal part of the webinar. So I'm going to share my slides here and start us off for the day. Okay. So welcome to this very special live Q&A on taxation. This is for e-residents. Many of you whom are cross-border business, have cross-border businesses and are entrepreneurs working across borders. I'm going to introduce myself first. I'm Hannah. I'm the head of content at e-Residency. And I'm joined also by two of my colleagues, Lina Vatras, who is our new managing director. This is her baptism of fire to help with the moderating the questions for us today. And also my colleague from our support team, Katrina Koppel, as well. So thank you to you both for your help today. And I also want to introduce you to two very special guests who are going to be helping us with the difficult tax topics. Firstly, Taavi from IBCCS Tax here in Estonia, and also international tax advisor and founder of IBCCS Tax Group, Cezary Zieniuk. So I'm going to hand over to you, Taavi, to maybe do a brief introduction of yourself, and you can go from there.
Good afternoon, everyone. This is Taavi, and happy to be one of the navigators today on this intellectual safari and dig deeper into the international tax, and particularly as it pertains to Estonia. I see there's a lot of people here, which I'm very happy about, and I'll skip the self-praise for now and give word to my colleague Cezary.
Hi guys, also very happy to be here, obviously. As Hannah introduced me, I'm the founder of IBCCS Tax, and I'm the international tax advisor, and I will be briefing you about all the obstacles and challenges you guys might have by being e-residents or by having an Estonian company. It's worth to mention that I'm also e-resident, and we have actually set up our office a couple of years ago in Estonia with Taavi, and we did it fully online with the help of e-residency. So it's definitely worth to be mentioned, because even professional companies like ours, law firms, etc., can use e-residency for the setup. It's not only for the freelancers and digital nomads. Yeah, that's it about me. A couple of words about our firm. We have offices in Estonia, in Cyprus, and in Georgia. We are presenting regarding Estonia today, so obviously we'll put more effort and focus on Estonia. We are international tax advisors in the office. Usually when we onboard the clients, we start with the advice, and then we provide supporting services. Obviously, we do provide accounting services. We assist our clients with the setup of the companies, with the tax advice, and we do provide a bunch of other needed support services related to accounting, tax, and administration. And let's not waste more time. If somebody will want to contact us and discuss, who we are, what are our services, you can visit our website, or you can ping us later on.
Thank you both. So yeah, as you said, let's not waste any more time. Quickly, just today, we're going to break the webinar into 3 parts. The first part, I will give a brief introduction to e-Residency. I'm sure that there are some people on this call who maybe don't know much about e-Residency and they've heard about it for the first time through finding out about this webinar. So that will be a very short section just to get everyone on the same page about what we're doing here today. I then will hand over to Taavi, and he'll sort of give you the broad overview of taxation for e-residents, provide a bit of context about the international tax system, talk a little bit about types of taxes and their treatment, and also introduce you to the Estonian tax system, which is a little bit different from other country tax systems. And then Cezary will go into a lot more detail on international tax concepts like permanent establishment, like dual tax residency, and also discuss a little bit the risks and possibilities for structuring ventures across borders. And finally, I just want to mention that we will be trying to give you as many examples and case studies as we can, because I think this is a really good way to introduce the topic of tax. And we'll also answer as many questions as we can, both in writing and also spoken as well throughout the webinar in the Q&A tab. Before we get into the meat, the content, a little disclaimer. We can only provide you with general guidance. And as I said, we're going to try and give you as many examples and case studies as we can. But be aware that where you and your company pay taxes will depend on your own individual situation and a number of specific factors, structurally, operationally, and more. So please don't rely solely on this webinar. Use this webinar as a way to get up to speed on all the topics you need to know about. Think about how you might structure, but then definitely go and seek the advice of tax experts like IBCCS Tax about your situation, so that you can put, the learnings that you have today and ask the right questions into practice. So let's talk about e-Residency. So firstly, I want to talk a little bit about what is e-Residency. So it's a digital identity. It's actually a card and a certificate that gives you the right to access Estonian e-services, provide secure digital signatures, and also start a company in Estonia and run it remotely from wherever you are. The actual card is very similar, and the certificates that you get are very similar to what Estonian citizens and residents have themselves. It's a special type of digital identity for e-residents, but basically the way that you would use it and the way that you would start your company is identical almost in every way to how Estonians do it themselves. The other thing that e-Residency is, which we're very proud of here, is it's a global community, and it's a network of entrepreneurs across the world. So it's not just a gateway to do business; it's also a gateway to a huge community and network. It's also important to talk about what e-Residency is not, though, because some of these are common misconceptions, particularly because we do have the name e-Residency. So it's not a travel document. You can't use it to travel. It's also not a citizenship visa or residency permit, and doesn't give you a right to that. It's a separate system, separate program from those things in Estonia and in the EU. One thing that it is not a tax residency, and we will talk about this today, what that means. But essentially, Estonia is not a tax haven, and e-Residency doesn't exempt you from domestic tax liabilities that you might have in countries where you live or work. And finally, on banking, because business banks and fintechs make their own decisions about who they take on as clients, it's also important that to know that e-Residency won't guarantee you a bank account for your business. So this is something that you need to be really aware of from the beginning, and think about and maybe make your own inquiries, do your own due diligence before you become an e-resident and start a company. So let's talk a little bit about starting a company. Why would you want to do it? One of the reasons is that Estonia has an extremely transparent and secure digital business environment. And as I've mentioned, you can start your company from wherever you are and run it digitally. using your e-Residency ID. Estonia also has an extremely easy way to do business because of the digitalization, and also because the country is very customer-minded and customer-focused, and wants users to have the best experience in every way in doing business. They want to make things as easy as possible so that you actually spend time on doing the important things. Like, growing, creating value, doing your taxes, and more. There are a lot of opportunities to scale and grow here in Estonia. It's well regarded by investors and venture capital firms. If your company has a legal structure here, there are a lot of events that you can come to Tallinn or Tartu in Estonia and meet investors. You can meet government advisors, policymakers, and get support that way. And finally, as I mentioned, there is a big community as well, not just e-residents, but also Estonian founders, service providers like IBCCS Tax, and others to help you in your business ventures. So let's talk about the process. So to become an e-resident, you can apply online. The form takes about 30 minutes to complete online, maybe a little bit longer if you have some, if you're a bit more minded about the writing long answers. And once you've submitted that, the Police and Border Guard, the Estonian Police and Border Guard, will run a background check. And once they've decided that you're a successful candidate to be an e-resident, they'll let you know, and you'll get an email from them about when you can pick up your card, either from them in Tallinn, if that's where you've chosen, or elsewhere in Estonia, or you can also pick up your card in over 40 locations at Estonian embassies worldwide. So the entire process from where you click submit to where you pick up your card takes on average between 3 to 8 weeks. And the cost is 100 if you decide to pick up your card in Estonia, and 120 if you pick it up from an embassy. You can start a business as soon as you have your e-residency card in your hand. And it takes on average 2 hours, although there has been an e-resident who did it live on stage at London Tech Week in 2022 in 15 minutes and 33 seconds. So you can try and beat that record, or you can take your time, but still only do it in a couple of hours. And to help you start and run your business, we have an e-residency marketplace, which I'm going to cover a little bit more in the next slide, where we've gathered 129 service providers to help you with company formation, accounting, taxes, and more. So so that's a real help for when you're getting started. The numbers are here on the right-hand side. We're about to celebrate our 9th birthday next week, actually, and so it's very cool that this year we reached the milestone of 100,000 e-residents, and they've started over 28,000 companies in Estonia since the program began in 2014. So I've included a slide here that I'm not going to talk too much about, but I just wanted to raise a couple of points. And at this point, it's probably a good time to tell you that I will make sure that you get a copy of these slides. You'll be able to download them from our website from the link that you get tomorrow in your follow-up email. So don't worry too much about scribbling down things that we're writing and talking about. And also the other thing that I want to tell you as well is this webinar is being recorded and live streamed on YouTube, so you can rewatch after the webinar's over. So sit back, relax, don't worry too much about the content, because yes, you'll have lots of opportunities to rewatch and find out more. So the few things that I wanted to show here, this is a comparison of starting a company in different countries from a foreigner's perspective. So if you live outside the country in question and you want to start a company in that country. So with Estonia, the easiest way to do it is with e-residency, and we've compared it across the board, a number of different factors here with these countries. So the first one I want to point out is what I was just talking about, how quick it is to register a business. In Estonia, it takes on average 2 hours. You can see that in these other countries, as a foreigner, it takes much longer. So that's the first thing I wanted to point out. The second thing is that with e-residency, you don't need a special visa, a special agent, like a local agent, or like a resident director or a shadow director in Estonia. In fact, that's actually illegal in Estonia. The shadow director part, not the resident part. You can actually start a company on your own, or with other e-resident shareholders, or with Estonian shareholders as well, as an e-resident very quickly. In US, Delaware in particular, you need an agent to be able to do that with you. In Ireland, you actually need to have a resident director from the European Economic Area. In Singapore, you need a local director or a special visa, and in Portugal, an agent or a visa. So just something to be aware of, that it is a lot easier in Estonia and also in London to start without those things. Another thing to be aware of is that the digital ID card, which provides so much security and so much trust to be able to run your company, without having to worry about security issues and nefarious people trying to steal your data or these kinds of things. In Estonia, you have a digital ID card. Singapore, you also do as well. And you can access generally all the e-services that Estonia offers that are relevant for you running your business. This is limited in Delaware, in Ireland, and in Portugal. In fact, I think that a lot of the business that you need to do in those jurisdictions is still paper-based. So something to be aware of. And we are talking about taxes today, and so I won't go too much into detail on the rates because we'll talk about that later. But Estonia is relatively in the middle, I would say, when it comes to tax rates, on the lower side, but in the middle. But when you look at how long it takes to file tax returns in Estonia, it's much lower than in other jurisdictions. Maybe an hour a week, or at least a couple of hours a month. And I've been told by my Estonian colleagues and friends and other e-residents who see this number that, it doesn't take 50 hours. This is sort of the ballpark figure, the average. Okay, so I mentioned the marketplace. This is a business directory that we have on our e-residency website, and this is where you go to find support to start and run your business. The only mandatory service you probably will need is a local contact person, and we have many on our marketplace that can help with this. These are mandatory in Estonia for companies with a foreign management board address. So for many e-residents who live overseas and run their company, they will have a foreign management board address, and so they will need a contact person. They're not the same thing as a local director. They don't have any responsibility or liability, in terms of like financially or legal duty wise. All they are is a messenger and a mailbox for your company. And they have to be specially licensed or come from a series of professions, like I think attorneys, notaries, judges, these kinds of things, special accountants, these kinds of things. So make sure when you do sign up with a contact person that they have the necessary license or are of the right profession. And also on the marketplace, you will find services to help you with company formation, accounting, business consulting, taxes, business banking. We have 2 Estonian traditional banks on our marketplace and about, I think, 10 or 11 fintechs that can help you with business accounts for your business. So that's a really good place to start if you're looking for a business bank account. Okay, before I hand over to Taavi, I just want to make a special announcement here. We have been running since May 2022 a special reimbursement offer for Ukrainian citizens. So e-residency will reimburse the e-resident application fee, that 100 to 120 euro application fee, to Ukrainian citizens who become e-residents. And we have several participating service providers on our marketplace. You can find them because they have the Ukrainian flag logo and the Ukraine tag on their profile, who will reimburse the fee to start a company, which is 265 euros. So look, it's not a lot. We know that Ukrainians are going through a very difficult time. So it's not a lot, but it's the little thing that we can do to try and help you, with your business dreams and journey in Europe and beyond. Okay, Taavi, I'm going to hand over to you. And I'm going to stop. I'm going to mute myself, and I'm going to have a look in the Q&A tab and see if there's some good questions that maybe I can raise while you're talking as well.
Thank you. So let's get down to uncovering the pivotal question of where in the world might you or your company be liable to pay taxes. And of course, there are plenty of countries to do business, and those who still are considering like where should they establish a business, we will also try to highlight some benefits of Estonia, especially from the tax perspective. But I must mention that also, those aspects of banking, good legal regulations is also very important parts from business perspective. So we'll not be covering this today. Maybe let's switch to the next slide. So one might have a feeling that the world has evolved quicker than the tax regulations in general, which seem to be lagging behind, and the regulations might not always take into account the modern needs of businesses. And it takes time to make major shifts in the tax regulations. So in general, you have different type of taxes depending on the type of income. Also, sometimes in certain jurisdictions, even the existence of assets will be taxed. And Estonia doesn't follow this model. And today we'll focus more on the corporate and personal taxes, which seem to be more confusing. Overall, social tax and VAT seem to be generally more easier to understand, at least the basics. So whether, maybe move to the next slide, please. Whether you are a digital nomad or a multinational corporation, understanding the nuances of tax residency and different tax laws is the key to safeguarding your income and staying compliant. We will discuss what the tax treaties are and how they can impact your business, and look into some cross-border structures as well. Yeah, like I mentioned, discuss the personal tax. Let's move to the next slide, please. So where and on what basis should tax be paid? So in general, a legal entity or a natural person can be tax resident somewhere and be subject to either its worldwide profits or local profits. And the latter applies in jurisdictions where it's considered as territorial tax, but Estonia follows the worldwide taxation model. Or the legal entities could also have permanent establishments and be subject to only just locally sourced income. In Estonia, resident companies are taxed on profits distributed from their worldwide income, while permanent establishments of non-residents in Estonia are taxed only on profits distributed from income derived from Estonian sources. Now, when it comes to tax treaties, it's important to note that in general, tax treaties do not impose taxes. Tax is imposed only by domestic law. Therefore, tax treaties limit the taxes otherwise imposed by a state. In effect, tax treaties are primarily relieving in nature. Similarly, tax treaties do not allocate taxing rights, although it is often claimed that they do. In light of this fundamental principle, it is usually appropriate before applying the provisions of a tax treaty to determine whether the amount in question is subject to domestic tax in the first place. And if the amount is not subject to tax under domestic law, then it is unnecessary to consider the treaty. So And let's look further into the Estonian tax law first. So you can move to the next slide. First of all, a legal person is a resident in Estonia if it is established based on the Estonian law. So meaning that all Estonian companies are Estonian tax residents, just based on the incorporation principle. And based on domestic law, Estonia can also tax foreign companies' permanent establishments in Estonia. And registered permanent establishments are subject to corporate income tax only in respect of profit distributions, both actual and deemed, as defined in domestic law. Estonian companies could also be a tax resident in some other jurisdiction that considers the tax residency of the company, for example, based on the location of the management. So quite often in the tax treaties, there is a provision that in the case of legal persons, if the corporate residence is based on the domestic law in two treaty jurisdictions, the competent authorities of the contracting state shall endeavor to settle this question by mutual agreement. So in theory, Estonia and other country could also agree that the tax residency of the corporation is in the other country, in this case, not Estonia. But it also usually includes the provision that in the absence of such agreement, the purposes of the double tax agreement will not apply, and the person shall not be entitled to claim any of the reliefs or exemptions that are provided by the double tax agreement. So I must mention that Estonia stands out in various international lists with its tax benefits, and also based on Estonian law, the Estonian corporations are subject to tax on their worldwide income. It doesn't necessarily mean that all the worldwide profits or whatever the income that is flowing into the company gets always taxed with 20% corporate income tax. First of all, Estonia follows a distributed profit model, meaning that this 20% tax is only paid when profits are distributed as dividends. So this allows companies to reinvest their profit without any immediate tax liability. Furthermore, there is no withholding tax on dividends, since this 20% tax is actually considered a corporate income tax from Estonian perspective.
Taavi, we have a question. Someone's seen this 14% regular distributions. Can you just explain maybe the difference between the standard rate, which is the 20%, and the reduced rate as well?
This is rather complex. This 14% applies on the regular profit distributions, but one should carefully consider also, like I mentioned, the different sources of income that the company would get, especially if we look into the various cross-border structures. Then the income tax code is quite complex in this regard. I might have difficulty to explain it in a few sentences, but basically, if let's say all the income and operations are in Estonia, then the companies get access to this lower rate, and depending on where the individual is has the personal tax residency, then it could be subject to the withholding tax of 7%, or in certain cases also 0 tax rate, depending on the jurisdiction.
And one more question, just while we're on this topic as well. Someone's asked for clarification of, is there any limit to how profits can be reinvested? So if a company does not distribute any profit, is there any limit to how it is reinvested? Maybe you could just talk about what does reinvested encompass, or not include?
generally, the investing should be for business purposes, for generating income. I think that we can say that this is the main principle. So for non-business related expenses would not be considered reinvesting. So it must be justified from the business perspective. That's the main principle. We cannot say that certain things you cannot buy. If it relates to the business, then it's possible. So it's a matter of how the tax officials will perceive it, how exactly the.
So generally, so like keeping it in a savings account or an investment account for the good of the like making interest for the company, paying salaries, business related expenses, that would come into that.
Exactly. Yeah.
Okay, great. Thank you. Sorry, please go on.
So we can move forward to the next slide. Like I mentioned that about how the Estonian model works in general, and that if you are an Estonian company doing business or receiving income from abroad, you might be also wondering like about the tax implications, especially from the Estonian perspective. And there's multiple things actually to consider. The general principle is just is 20% tax, but you would like to also consider the participation exemption, which is a significant aspect, especially if the company has foreign holdings. Assuming certain conditions are met, there might be no tax on such income on a parental level in this case. So if the Estonian company is like a holding and has a subsidiary in other jurisdiction, those dividends or profit distributions might not be taxed on the Estonian levels. Furthermore, Estonia also exempts profits of foreign permanent establishment from taxation, again, provided certain conditions are met. So somebody who has operations abroad, outside of Estonia, and operates this way and registers the permanent establishment abroad and might even pay taxes locally, then again, Estonia will, in most cases, exempt such profit distribution. So if they're repatriated to Estonia and then to the shareholders, generally there is, in most cases, no more tax to be paid to Estonia. It's also worth noting that in certain circumstances, domestic or foreign taxes may also be creditable against this 20% corporate income tax charge. So this usually relates to the taxable income abroad. So if Estonian company already had paid some tax in some other country, like take for example United States, sometimes for certain types of income, there might be paid some tax, like 15% in many typical cases, and then Estonia might actually give tax credit against this. So once this income is redistributed, it can reduce the tax obligation in Estonia.
So just to clarify, because there is a question on this withholding tax. So just to clarify, withholding tax on dividends, if your country, if you live in, say, the United States or another, it could be any country, you just say, let's say United States, and they withhold tax on your dividends from your Estonian company, you can get tax relief in Estonia on the corporate income, right? Is that right? The sort of general? Okay. So Christian, I think that's an answer to your question there. So it would be about
Also, we will. My colleague Cezary will soon show some examples. Also, like overall, where the tax is paid in overall when we consider all the aspects of personal tax residency, corporate tax like where the business is, how the business taxes are paid, and also how the taxes are paid on a personal level. And here we will see that also that in certain cases it actually might be or beneficial to consider also relocating to Estonia and actually, moving from being e-resident to becoming actual Estonian resident. So we'll try to highlight some of these benefits as well, and included these are also on the slides. And one of the key benefits I can mention is that on a personal level, these dividends that Estonians would receive from Estonian company, generally they are not taxed. I mean, if we don't consider this lower rate, which is in a 14% rate, which could, in this case, on the personal level, the 7% is paid. So it's same applies for many foreign dividends. So Estonia actually doesn't tax different dividends that are received from abroad, provided certain conditions are met. Like again, if it's the income tax has been paid on the share of profit on the basis of which the dividends are paid, or if income tax on the dividends has been withheld in foreign state. So in this case, as Estonian tax residents, we can enjoy the benefit that these dividends are not taxed further in Estonia. And as I mentioned, that we have to also consider specific cases because sometimes the domestic law provides lower rates. Sometimes we can actually benefit from the treaty. And Estonia also has quite high number of tax treaties with different countries. So it might be further complicate things. And we have to consider exactly the individuals, the shareholders, where they are resident, and whether we could actually access the lower treaty rate sometimes. And how Estonia stands out in the landscape of the whole world, I can say that one of the benefits that the tax residence in Estonia actually doesn't require also minimum stay. So Estonian legal residents are also usually become Estonian tax residents, at least based on the domestic law. But again, this here we also have to consider treaties when two countries consider based on the local law individuals as tax residents. Usually this is also settled by the competent authorities based on the Double Tax Treaty. So everyone's individual circumstances should be analyzed further, and there are also these international structures which could also, have different kind of implications. And my colleague will now take over and show some examples and case studies. And also just to briefly mention this other aspects. Will not focus so much on the employment. Of course, this depends mostly on where the work is performed, but it's worth mentioning that or highlighting the fact that Estonia doesn't impose any additional taxes on the employment income if the employment is based on abroad and the person also is not considered tax resident in Estonia. Also, the director's fees from the Estonian company are always taxed in Estonia. And this is also usually regulated by the treaties exact same way. So yeah, so we can move over to the next slides. There are various aspects that one should consider when setting up business structure, and also in the future it could impact significantly. For example, if you set up your startup and you plan to sell shares or raise funds in the future, and also for considering for like inheritance, or if you plan for succession and you want to leave legacy to your kids in the future. Tax aspects are definitely important, but also for maintaining operational flexibility and isolating the assets and business from certain risks that they might be exposed to. So that's why also always advisable to discuss with advisors, because usually those decisions cannot be easily reversed or mitigated once they are done. So I'll just give word now to my colleague Cezary. Cezary, please tell us more about international tax.
Thank you, Taavi. I was asked to speak a bit louder, so I will do my best. I hope everyone can hear me now. The purpose of my slides and of my presence here is to give more explanation and understanding of how certain things in international tax work. Because as most probably most of our participants here are e-residents or owners of Estonian companies, and we have been hearing from many clients and people around that many people struggle about understanding where they should pay taxes, and many people have not really correctly structured companies. So I would like to spread the news to you and give you as much of information as possible. And I hope after this session you will be able to at least understand the basics of what risks you might have in your structures in the Estonian companies. And maybe on the other hand, I will be able to make you interested in moving to Estonia or setting up a business in Estonia and investing in Estonia, because what we'll be also discussing is substance, which means relevant infrastructure in the certain jurisdiction. So you will see that in certain cases, you will have to do some small investment in Estonia, which actually might be a good thing for you because it might bring you a good return on investment. So I will be describing two most important issues/risks that exist. One of them is permanent establishment, another one is the residency. And I will be talking also about some personal residency issues. So what is a permanent establishment? Permanent establishment is a fixed place of doing business. In order to, this is the definition. It's a very simple definition, and it has two factors. It has a fixed place. So in order for you to have a PE, you must have a fixed place, meaning, for example, an office, a construction site, some kind of place in the jurisdiction abroad where you do business. And there has to be also a second element met. Business meaning sales, which means that in order for you to create a PE abroad, not only you must have a fixed place, but you also must have sales or any operations that are generating sales. Any activities that are supportive matter or auxiliary matter, they do not constitute a PE. And what you can see here is actually an article from a double tax treaty between Cyprus and Estonia, if I remember correctly. And this is a live definition of how the treaties describe PE. So you can see a couple of examples like place of management, a branch, an office, factory, workshop, etc. But have in mind that these two factors, which is fixed place and business, meaning sales, must be met together in order for you to create a PE. For those who do not understand how PE works, PE is basically an infrastructure of, in this case, Estonian company abroad that gives a right to the other tax authority to tax these operations. For example, we might have an Estonian company with director being in Germany and an office in Germany, and because of the director is making business through this office, this might create a right to tax to the German tax authorities. Can we go to the next slide, please?
Yes, sure.
Thank you very much. So, as I mentioned, the PE has only activities that are generating sales. If a Estonian company rents an office abroad and this office has activities based on only marketing, preparatory administration, or auxiliary services, it does not generate sales. It does not lead to any income. This does not create a permanent establishment. So you actually might have an Estonian company with offices abroad, with employees abroad, but they must perform only preparatory and auxiliary functions. Next slide, please. And couple of slides after, I will show you the examples of how PE works, and I will actually show you the real case study that we also had.
Cezary, can I just ask you,
Sure.
there are a few questions from people who have only internet business where they only sell products or services over the internet. Mm-hmm. So they're wondering how that works for them when they don't necessarily have an office. Maybe you can just talk to that a little bit with the PE, because I think maybe we don't want to confuse them. We want to make sure that they don't cross the line here.
in these cases where we have companies doing some online services, usually what matters is the place of management, place of taking decisions, and sometimes it matters where the IT infrastructure is based. But this is a more complex topic. I mean, mainly it matters from where the director is doing the business. So if we have an Estonian company and let's say the director is based in Cyprus or in Germany and is managing the Estonian company from the other jurisdiction, technically the other jurisdiction can inspect based on the fact that they found out that somebody is, sitting in Limassol in Cyprus and is managing a huge online operation. And once the Cyprus tax authority, in this case, finds out how many percent of income is relevant to Cyprus and how many percent is relevant to Estonia, and in this case, since this person would manage everything from Cyprus, we would have 100% of the operation tax in Cyprus. So technically, this could give a right to a Cyprus authority to tax the operations. But you should also have in mind that practice is sometimes very different from theory. What we're discussing here is a theory, but in practice, in most of the cases, the tax authorities do not know that somebody is, residing or managing the business from another country. Because it's in practice, it's very difficult to prove, and especially in the countries that do not have very developed infrastructure in terms of exchange of information. So yeah, I hope that it answered the question about the potential PE generated abroad by the online businesses. But it all depends. There is every example should be treated case by case. But as if we have a company with no substance in Estonia, no infrastructure in Estonia, usually the key factor is the place of management and what is happening in the other country when the director is managing these operations.
Yeah. Okay. So great. And so I think that the answer to those people as well is like, make sure that you consider the double tax agreement between Estonia and the country where you are, and so read that, because it may be similar to this or it may be different, and check how your local tax authority, what they consider a permanent establishment, and whether they consider that it has to be an office or whether it could include a room in your house or whatever it is.
Actually, there is a very valid point related to the example that you've mentioned, Hannah. On this slide, you can see a couple of definitions related to the dependent PE, or a situation where an Estonian company, in this case, would, let's say, invoice another company abroad. And because of the independent relationship because of, let's say, Estonian company would be only invoicing a different company and it would have no other clients, this could also create some tax risks. The fact that we do not have an employee abroad in the Estonian company, the fact that we would have a contractor servicing, the Estonian company, this might actually also create a risk of having a PE. So be very careful with the structures where you have only one client. It might give some tax risks to this client, actually not to yourself, but usually to the client. We can go to the next slide.
Okay.
So here we have a very clear example of a permanent establishment. And in purpose, I have spread the company, the shareholder, and the director into different countries. So in this case, we have the ESTCO OU, which is the company in Estonia. We assume that this company is a tax resident of Estonia, for the sake of the example. We have the shareholder being a tax resident of Georgia. And by the way, this might be beneficial for some people because Georgia doesn't tax foreign dividends. So Georgian tax resident having Estonian company receiving dividends from Estonia is actually not taxed in Georgia. But in any case, this is not the topic for a discussion. And then we have Cyprus, a third country, in which we have the sole director. So in the Estonian company, we don't have any office in Estonia, we don't have any substance, any employees, any infrastructure. There is director living in Cyprus, and he's actually actively managing the business of the Estonian company from Cyprus. So in this case, it's a very clear example that the permanent establishment of the Estonian company is in Cyprus. And technically, Cyprus Tax Authority has a right to tax all the operations of the Estonian company that refer to involvement of this director of the Estonian company that lives in Cyprus. So it might be a problem if you think in theory, but on the other hand, if you consider the low tax rate of Cyprus, it might actually be considered as a benefit in some cases. So sometimes by creating a PE in other country, like in Cyprus or in Malta, where the corporate tax is a little bit lower than in Estonia, it might actually give you a small tax planning benefit. But in any case, this was not the purpose of this graph. The purpose of the slide was to explain to you how easy it is to prove a PE. So the solution for mitigating the risk of the permanent establishment is on the next slide.
Okay.
And the solution for mitigating this risk is substance, obviously. As I mentioned before, substance is the relevant infrastructure that proves that you are doing the business from the country. So in this case, when we are discussing substance in Estonia, in which case we do not want to show that we have a permanent establishment in Cyprus or in the other country. We must prove to the Estonian authority and to other tax authorities in case we have a cross-border claim that actually all our operations are being done from Estonia. For this purpose, we shall have the Estonian resident director who is managing the business from Estonia. If employees are coming into this example, we should have employees based in Estonia, so we don't have the PE risk abroad. We should have an office owned or rented in Estonia, and basically have all the operations in Estonia. I mean, it's all case by case. I cannot say that there is some universal formula for every client, but it's all common sense. You basically have to prove and do business in the way that it's done from Estonia and not from somewhere else. So you guys, the people who are watching us, you can quickly analyze your structures and most probably the structures where you are single directors based outside Estonia, most probably most of the structures have a risk of having permanent establishment abroad. So please think about how you are doing the business and try to be more compliant, because we know many e-residents that are actually very wealthy. They have tens of millions of turnover, and they still haven't really restructured the companies. They are single member companies based in Estonia, with directors being based somewhere else with no substance in Estonia. This kind of structures will definitely have a risk in Estonia, so be more careful. Let's go to the next slide. So, a couple of words about the tax residency. Let's first touch the topic of the personal tax residency, because it's a bit easier. And then we'll talk about the corporate tax residency. And we can actually go to the next slide, because I have included the screenshot from the double tax treaty between Cyprus and Estonia. So point number one in the Article 4, which describes the residency, is very general. It's usually being skipped. The individual tax residency is described in point number 2. There are a couple of main tests for establishing the tax residency from the international perspective, as you can see on this agreement. And what is worth to mention is that this test and the document which is here, which is double tax treaty, we are referring to this only if we have a cross-border claim. We are not referring to this if we are fine, or we are not referring to this if we have some, domestic tax situation. So in this case, we assume we have a claim between Cyprus and Estonia, where an individual should be a resident for tax purposes. So the first test is Article 4.2a, is permanent establishment, permanent home. I went too far to the company. It's very easy. Permanent home is basically an available place for the taxpayer, the available place in terms of being able to live there. So it's usually a house or a flat that somebody has in the country. Let's give an example. In this case, we're discussing Cyprus, Estonia. So in this case, the tax authority might say, okay, you have a flat that you own in Estonia. You claim that you have a residency in Cyprus. You have told us that you also bought a flat in Cyprus, or you rent a flat in Cyprus. And this situation says that we have permanent home in two countries, in Estonia and in Cyprus. And if the tax officers insist and there is a proof that a taxpayer has a permanent home in two countries, then we go to the next test. And the next test is called Center of Vital Interest. It's a very important test. It's a mix of personal, social, economic, and business elements related to the person. It's much more broader than permanent home, obviously, but because it includes such factors as where do you have your social life, where do you have your business infrastructure, where do you have your wife or husband, where your kids go to school, if you're part of some social club. So it's a very big, it has a large number of elements. And it's actually the most difficult test to be proven, because you basically need to prove that you have more in common with one country and less in common with the second country. So in this case, let's say the Estonian taxpayer moved to Cyprus, and we have a claim Estonian tax authority says that you have a center of vital interest in Estonia because you have a company here and you have a flat. But if this taxpayer living in Cyprus has his kids going to school in Cyprus, he has active social lifestyle in Cyprus, he might also have a business in Cyprus, he has his family there, he spends most of the time in Cyprus, then he should definitely be considered to be a CY tax resident. But it's a very complex topic, I'm not going to elaborate more on this. It's again, case by case. Next test, if both tax authorities say that the center of vital interest is in Cyprus and in Estonia, then we have a test called habitual abode. Habitual abode is a very specific test, basically proving that the person
visits Switzerland. I'm a black share. Where would I be tax liable if I get a digital nomad visa for Argentina or Brazil? And that's
Katrina, I think you have your not muted. Yeah. Sorry, Cezary.
No worries, no problem. So habitual abode is a situation where we do not measure the number of days we stay in the country. It's a situation where a taxpayer visits another country on the regular basis for an important purpose related to his overall income and tax situation. For example, if I live in Cyprus, even if I live in Cyprus for 260 days or 310 days, if I go to Estonia every month for 3 days to make important decisions that affects my tax situation, I might be considered as a tax resident of Estonia, even though I have my family in Cyprus and even though I spend most of the time in Cyprus. So it's quite tricky. And the next test after the habitual abode, if both jurisdictions assume that there is a habitual abode, then we have nationality. So if you are a holder of the passport from Estonia or Cyprus in this case, and then if the authorities do not agree, then they have a special procedure when they will try to agree, basically.
So Cezary, just while we're on this topic, we have quite a lot of people asking about, the digital nomad question, like how can I prove that I'm a digital nomad? How can I be a, non-habitual resident, these kinds of things. Last time we did a webinar, we had a good conversation about this and you gave some really good answers. So I wonder if you could just talk about that particular segment for the benefit of these digital nomads we have in the call.
Well, it's a very interesting, but on the other hand, very tricky topic. I think most of the people who are digital nomads, they're trying to prove something that is called being a perpetual traveler. So basically having no tax base somewhere and being a non-resident for tax purposes in any country. The simple answer is it's almost impossible to prove. Because first of all, we live in such a world that we need to provide tax declarations. We need to pass compliance in the banks. If we want to invest, we need to pass compliance in the brokerage accounts. If we take a loan, we need to pass compliance. They're asking us to provide tax declarations. So even if you have not been a tax resident somewhere, probably somebody will ask you to provide a tax declaration, and then you will have to think where you should be a tax resident and then declare, maybe pay taxes in that country. So first we have this necessity of being taxpayers. But to answer your question, being a perpetual traveler is very difficult because you need to prove that you have no links to other countries. Maybe you don't have maybe you don't have a family, or maybe you don't have a house, or maybe you don't have any infrastructure that binds you to some country specifically. If we have such a taxpayer that has literally no kids, no wife, no businesses, no families, and no link directly to one country, then we have a good situation. But still, we have to prove that this person constantly travels and has no attachment to one country, and it's very difficult to prove, because we literally need to prove that somebody is traveling every week or every 2 weeks or every month. And usually in practice, there is in 99.9% of cases, there are people who have parents in a jurisdiction or business or properties, and usually it's impossible to be proven to prove that somebody is a tax resident of somebody is not a tax resident of any country. So
and also, I think we talked about this last time. If they ever want to get a bank loan or a mortgage or something later on, it would be difficult for them to show that they didn't pay taxes for several years. So it's
plus one more important point. If somebody tries to have such lifestyle, they should keep track of their life, because let's say Germany, which is quite strict with taxes. Let's say we have a German national who was living in Germany, then he disappeared from the German tax system. He's traveling around the world. He's spending a few months here and there, and he says, "I'm not a resident of Germany." But most of the countries, what they will do, they will tax him, and they will say, "Prove to me otherwise." And usually this kind of people still have some kind of link to their country, and usually they're not able to say, okay, I was outside, traveling around Caribbean islands. I have no family in Germany. I have no home in Germany. I have no business in Germany. I have nothing in common with Germany. This is a very rare situation. So this should be considered for people being nationals and residents or residents of the countries that are strictly speaking chasing others. Probably if you are a national of some non-developed country from Africa, you don't care. But if you're a national of countries that have developed tax systems, maybe Russia, maybe Germany, then you should be careful.
Thank you.
Second topic about the residency, very quickly. How do we establish a corporate residency? So how do we handle the tax residency of the company? So in Estonia, we have the incorporation principle as the binding one, as a default one, which means that the company incorporated in Estonia is a tax resident in Estonia by default. There are also two other concepts in terms of international tax when we establish the residency of the company. The second concept is called management and control, and this is a very simple concept, basically stating that the company can be a tax resident of a country if the decisions are taken from that country, and if the director is managing and controlling the company from that country. So in this case, let's say, I will give an example later, but for the sake of explanation of how this principle works, and Cyprus is the jurisdiction that has this principle. When we have a company registered in Cyprus and we have a director who is taking decisions from Georgia, for example, or from Estonia, this Cyprus company might be a tax resident of Estonia if Estonian director of a Cyprus company is basically managing the company from there and taking decisions. I think it's clear. And then we have a third concept, which is very similar. It's called place of effective management, but it has a totally different meaning and is very different than the management and control principle. In place of effective management, what matters is where do you have the infrastructure that actually does the business. So making decisions, taking decisions, and managing the company doesn't matter so much. What matters is where are the operations of the company, where are the employees, where is the office, where are the processing, where are the processes of the business located. So it's more physical infrastructure related to the business rather just than the place of the management. And I think I have answered one of the questions because somebody was asking to give more details about the place of effective management. And as you can see from the Article 4 in Double Tax Treaty between Estonia and Cyprus, we had the first point, which was a very general description of how you can establish the residency. But actually, point number 3, which you can see on this slide, describes how, in terms of the cross-border claim, jurisdictions should establish the tax residency of the company. And I have highlighted here that the competent authorities should settle the question about where is the place of effective management of this entity. So if Estonian company even has a director from Estonia, but the place of effective management meaning employees, processes, and all the business infrastructure is based in Cyprus, then Cyprus might have a right to tax this Estonian company. So you have to understand that when you are setting up a company, you should make sure you don't have a risk of having the place of effective management somewhere else. Because if you do, then you might have a problem. And again, it's case by case because every treaty is a little bit different. Usually, double tax treaties, they don't have very detailed explanations in terms of the tests. Here, the treaty between Cyprus and Estonia, in this specific regard, is very problematic. Why? Because as you read further, if we don't have the place of effective management established, or if we don't have any other relevant criterion established, then we might have a problem with establishing a tax residency. So the issue in this double tax treaty is the last 3 words, other relevant criterion, which means that the tax offices might disregard the place of effective management, because if they will find that other relevant criterion, which can be anything, is more important for the tax situation and for the income of this company, then they can skip the place of effective management, they can skip the location of a director, they can skip whatever substance there is, and based on some other relevant criterion that we still don't know what is it about, they can establish a tax residency. So when you are choosing the tax residency in this case, or when you are wherever you are doing business, please make sure to check the double tax treaties, and it's always best to choose the jurisdiction where the double tax treaties are very clearly formulated. This treaty between Cyprus and Estonia is definitely not the most clearly formulated, but this is also for a reason, I guess, because both Cyprus and Estonia, as you might know, have a very friendly approach in terms of the tax authorities assisting, helping, whatever you call it, the taxpayers. Cyprus tax authority is friendly, it's not, bureaucratic, it's not making too many inspections. On the other hand, Estonian tax authority is a little bit more developed, much more developed, but it's also not a pain. It also has a professional and decent attitude. So in this case, even though the treaty, the double tax treaty might be a little bit tricky, we don't have a problem because both of tax authorities are competent enough to establish A or B.
Cezary, we're coming sort of close to the end here, so maybe you can take us through the examples.
Yeah. Let's go to the next slides then. So very quickly, this describes what I have just said. So we have the Estonian company with the director being in Cyprus, but in Germany, we have the shareholder, and we also have employees, processes, office, etc. And because we have the place of effective management in Germany, then we might consider that the tax residency of the Estonian company is in Germany. Let's go to the next slide, please.
I think
Again,
we
substance,
Yeah.
very important to mitigate any risks. Next. I think I have just two more slides. I'll be very brief. This is just to show how dividends are taxed in Estonia. By default, and this is the principle in Estonia as well, dividend tax is paid on the level in the location of the shareholder, in the place where the shareholder is a tax resident. And in this case, we have a couple of different examples. If we have the Estonian shareholder who is a tax resident of Estonia, then the corporation tax and dividend tax is combined, as you and Taavi explained. So Estonian shareholder doesn't pay any additional taxes. We have the example of a Georgian person. In this case, the dividend tax is again paid in Georgia because Estonia doesn't have withholding tax on dividends for non-residents. In Georgia, there is no taxation on dividends or foreign dividends, so we have also a zero tax situation. Cyprus, very similar story, no tax on foreign dividends. Poland, there is a tax, unfortunately. So Polish e-residents and Polish tax residents actually have to pay attention to this. Have in mind the fact that Estonia will not charge dividend tax because there is combined model of corporation tax and withholding tax. It doesn't mean that you should not pay taxes abroad. So if you're a resident of Poland, when you distribute dividend from Estonia, you pay 20% in Estonia, but you should also pay local dividend tax in Poland. Next slide. This is an example of how Estonian business, in this case Estonian company, can expand abroad. In this case, we have Cyprus, and I chose a jurisdiction in European Union in purpose. Because if we have a subsidiary in Cyprus or in another country in the EU, based on the parent subsidiary directive, the dividends between one EU company and another EU company are not taxed. So if you have a subsidiary in Cyprus and the Cyprus subsidiary pays dividend to Estonia, there is no tax, no corporation tax, no dividend withholding tax. And in this specific example, on the domestic level, so on the local level, Cyprus doesn't have any taxation because it doesn't have any withholding taxes on dividends. And also Estonia, in this case, has the benefit of using the participation exemption. So as you can see from this example, you might have a situation where actually there is no dividend tax between the companies. Second slide, please. This is the same case, but in this example, we expand from Estonia to Georgia. In this case, very similar story. Estonian company should not pay tax because we have the participation exemption. Georgian company, once it's paying the dividend to Estonia, obviously it's paying the corporate income tax in Georgia. But in this specific case, Georgia can withhold 5% withholding tax. And this is an example that is showing that some countries actually can withhold the taxes on dividends at source. So when you're structuring cross-border businesses, when you're expanding abroad to Georgia, to Armenia, to other countries, pay attention on the treaties, because you might have a situation where other jurisdiction can tax you, could tax your dividends or other income. Next slide, please. We can skip it. It's just copy paste from the double tax treaty. Same.
Okay. So we've run out of time. So I think, unfortunately, we're not going to be able to finish the rest of the examples. But I actually, just for the audience to realize, I took these examples from our website. So you will be able to find responses to these particular examples. The first one was digital nomad, so no fixed place of business. The second was about where you have a very, very fixed place. I think we've covered these two examples pretty well today. So this is a German example, and then the final example is someone who has global operations. Maybe they have staff in different countries, multiple founders in different places, and they sell to clients globally. So these are examples that you can find on our website, on our tax page. It's called Understanding Taxes or Understanding Cross-Border Taxes. So you can find answers to these case studies on our website. But otherwise, I think we should probably finish here just because we have gone over time. And I know that people probably need to get around about their business. So I just wanted to take you through a few additional resources that you can have a look at on our website. We have a lot of blog posts on taxation. So you can look for the tag for taxation and law and find those blog posts. We also have a knowledge base that goes into a lot of detail on different concepts that we've talked today about permanent establishment, about effective place of management, double taxation. These were drafted in-house, but with the help of PwC Estonia as well. So it does have that legal touch. And finally, you can go to our marketplace, as I mentioned earlier in this webinar, and find a tax consultant to help you, because I think what has been really clear from everything that we've said today is that it is so specific. You really have to look at every single circumstance that you have personally, geographically, and how you work and where you work, and also your company has in terms of where the effective place of management is, what are the factors to consider to see if there's a permanent establishment in a country, and more. So get advice is my best advice to you. A few things that you can do after this webinar if you want to know more: leverage our community. There are many e-resident entrepreneurs out there, different types of entrepreneurs in different businesses, segments, countries, and they have done a lot of this already. So they can help you, find out more and also find the right people to talk to. So you can connect with them in our social media accounts. There is a Facebook group where you can go and ask questions. We have an events calendar where you can find more events, both in person and webinars like this. And we also have a subreddit. So that's a really good place to go. We actually moderate that in-house, but a lot of e-residents and service providers do help with responses there. And finally, we do have a small group of e-residency spokespeople who are sort of best in their field, e-resident entrepreneurs, and a lot of them have been early adopters. So they've figured all of this out over the years. You can reach out to them through our website, or you can also find some e-residents through EDICA, which is the sort of independent e-resident chamber organization. So those people can help you as well, figure everything out and see whether e-residency is for you. So that's it. I want to say a big thank you to Taavi and Cezary. Taavi, do you have any final thoughts to share before we end?
Thank you again. Unfortunately, we were not able to ask all the questions, but we will remain at your disposal for consultations if you want to explore this further. And I must say that in many cases, you must take into consideration the individual circumstances. So we cannot really generalize and actually give you like specific advice here. So we'll be available if you need us. Thanks.
And Cezary, thank you to you as well. Any final thoughts?
Well, as both of you guys said, every case is different, and I want to put a focus on the seriousness of this, because when people do business abroad, when people relocate, they don't think about this seriously, but actually it's a very serious thing to be considered, because it might have an extreme consequences of you being taxed by the country that you have left, or you being taxed by the country where you live, etc. So please consider this seriously. I know that yes, people who are launching startups, they pay attention on the costs a lot, but it might be worth to spend some little money for the tax advice, and then later being safe, you know, from troubles, and eventually a few €100 might save you millions in taxes. So that's my only comment. Thank you very much.
That's great advice. And I think the fact that we had so many people here today shows how serious people are taking the topic, and and so it's really good that our e-resident community is wanting to learn more and wanting to get advice on this. I've just seen a few final questions about recordings. Yes, you can already find this on YouTube as we were live streaming. So you'll be able to find a sort of a slightly edited version tomorrow. And in terms of the slides, you can download those tomorrow as well. You'll get a link to our website, and from there, you'll be able to download the slides too. And for any final things, feel free to contact us through our support email, which you can find on our website. And you already have IBCCS's contact details as well. So thank you very much. Thank you also to my colleagues, Katrina and Lena, for your help with the moderation. And I hope that everyone learned something today, and this is helpful in your business ventures. So good luck, and let us know how you go. Thank you very much.
Thank you. Bye.